Good morning and welcome to this joint webinar from Glaisyers Solicitors and HWB Chartered Accountants on intergenerational wealth and planning for school fees. Just to let you all know, we're recording this webinar, so if you do miss anything or have a technical issue, then we can make it available afterwards, or if you want to share it with someone else, please introduce them to us and we'd be happy to pass the copy on. If you've got any questions as we go, please post these in the chat box and we'll address them at the end. And if we have time, or we'll follow them up with a Q&A afterwards. So just by way of introduction and to let you know who we are, I'm Chris Burrows from Glaisyers Solicitors and I'm co-hosting this webinar with Gemma Hedges from HWB Chartered Accountants. HWB and Glaisyers are both part of ETL Global, which is a worldwide interdisciplinary network of professionals which combines tax, legal, audit and accounting services and advice. I'm a solicitor specialising in private client law and Gemma's a chartered accountant specialising in private client tax, and we're both members of STEP, the Society of Trust and Estate Practitioners. So to give a brief summary of what we'll be looking at today, we're going to cover some of the common wealth planning objectives which are faced by families. Every family is different and the planning and priorities will vary depending on unique circumstances. So today we're looking to give an overview of some of the planning options and some of the pitfalls that need to be avoided. When looking at wealth planning, most families want to retain control over their assets or to preserve the family's wealth, its capital. Arrangements put in place to manage wealth shouldn't be a set of handcuffs. Families want flexibility in accessing income or capital, but also want to protect it for as long as possible. Whichever planning options we use, there'll be tax consequences to take into account. This could be income tax, inheritance tax, capital gains tax, and these will apply to different people within a family in different ways. In the examples we'll look at today, we'll also cover the combination of different generations of families and the options to pass wealth down to younger family members from the older family members. Depending on the age of the children, this will commonly involve the payment of school fees or university tuition, but we'll also be looking at providing more generally for the younger generations of the family. To begin with, Gemma and I will set out some of the background on the tax and legal issues that are relevant in this type of planning, and we'll then go on to look at a couple of case studies from both the trust and company perspective. So to begin with, I'm going to hand you over to Gemma to look at the tax background.
Thank you, Chris. Good morning. So as Chris says, there are tax implications on wealth planning and family gifts, and it's important to consider that there may not just be one tax consequence. There may be a number of different tax consequences. So when making gifts, you need to make sure you've considered all the different taxes that could be relevant. Now, today we're just going to run through the main taxes that are relevant to most gifts. So that's income tax, inheritance tax, and capital gains tax. But these may not be all the taxes you need to consider. So for example, if you're doing a property transaction, stamp duty land tax would be relevant. And you would need to make sure you've thought about that when you do any planning to make sure you don't have any unwanted surprises a bit later on. So we're going to start with looking through income tax, and it's probably easiest explained the reliefs and the allowances for this tax and the different rates of tax that are applicable, so you can understand why we would want to do the planning and what the planning is designed to achieve. So every individual has a £12,500 personal allowance, and that allowance is tax-free income, and it doesn't matter whether that income is salary, whether it's interest, whether it's dividend income, that can all fall within the personal allowance. Personal allowance is, however, tapered away if your total income in the year is over 100,000, and the taper is £1 for every £2 you go over the threshold. So there's a possibility, once you get to 125,000, that actually you lose that 12,500 of tax-free income, and that can be quite costly from a tax perspective. In addition to the personal allowance, we also have a savings allowance, and that will differ depending on what other income you have. So if you're a basic rate taxpayer, your savings allowance would be £1,000. If you're a higher rate taxpayer, your savings allowance is £500. If you're an additional rate taxpayer, there is no interest income that is tax-free within the savings allowance. And in addition to the savings allowance, we have a dividend allowance, and this is £2,000 per person per year. And again, that one's not linked to any type of other income you have, that's just available to you. Now, you should note that these allowances are per year. They aren't carried forward, so there's very much a use them or lose them situation. Now, the rates of income tax depend on what your total income is in the year. The basic rate band is £37,500. if we add that to the 12,500 personal allowance, this means that if your total income is less than 50,000, you're going to fall in that basic rate band. So your salary and your interest is going to be taxed at 20%, and your dividend income is going to be taxed at 7.5%. If your total income is above 50,000, then you're in the higher rate tax band. And that means salary and interest taxed at 40%, dividend income taxed at 32.5%. And then we go up to income over 150,000. At that point, you're in the additional rate band. So we're now at the top rates of income tax of 45% on salary and interest, or 38.1% on dividend income. So when we're doing planning, what we're trying to achieve is trying to stop one family member having all of the income being taxed at that additional rate, the top rate's 45%, and potentially losing their full personal allowance. What we want to achieve with any wealth planning is trying to spread the income across the family members using everyone's personal allowance, ideally everyone's savings allowance, everyone's dividend allowance, and trying to get the total income tax rate paid across the family members down into that basic rate band. And ultimately, if we can achieve this, then we can move income potentially taxed at 45% into the personal allowance of another family member, then that's 45% tax saved on that income. And that's really what our wealth planning is designed to achieve when we're looking at it from an income tax perspective. So in addition to income tax, we also want to consider the inheritance tax implications of any gifts that we make. Now, inheritance tax is often the driving force behind wealth planning. People think, well, 40% inheritance tax is a big sum of money, and I don't want my beneficiaries to have to sell assets in my estate in order to pay the tax. But people often overlook the fact that there are a lot of reliefs available for inheritance tax. So everyone's entitled to a nil rate band. That's 325,000 of your estate that is free of inheritance tax. And that's available to everyone. That's not discriminatory based on the size of your estate or any of your income. That's just available to you. In certain situations, you may also qualify for the residence nil rate band as well. Now, this has been phased in. It's a relatively new allowance, but it's also tapered if your total estate is more than 2 million. And that taper works in a similar way to the personal allowance for income tax purposes. So if you go over that 2 million by £2, then for each £2 over, you lose £1 of your residence nil rate band. But regardless of that taper, the residence nil rate band is only actually available if you pass a residence down to lineal descendants. There are some downsizing provisions, but broadly, if you don't have children, then you do not qualify for that residence nil rate band. There are also spouse transfers available, and this is generally the case where one spouse leaves their entire estate to the other spouse. Then they can pass any unused nil rate band or residence nil rate band if they qualify across to the surviving spouse. So if you are the surviving spouse and you qualify for all of these different reliefs, essentially you can have £1 million worth of your estate free of inheritance tax before that 40% applies to the excess. So there's quite a few reliefs available here. When we do planning in inheritance tax, what we're trying to achieve is to make sure, if we do qualify for the residence nil rate band, that we make sure our estate is below that 2 million. And we can consider business property relief assets in this respect, because they aren't taken into account when getting to the £2 million total. So although they're not subject to inheritance tax, if they're 100% business property relief qualifying assets, they still may mean that there's a residence nil rate band taper, which we don't really want. So going back to the business property relief, as I mentioned, if you qualify for this, those qualifying assets are 100% free of inheritance tax. So that might be shares in a trading company, for instance. You can also get 50% business property relief on assets, for example, trading premises. So premises that your company trades from, but which you own in your personal name, not in the company name. Those assets will qualify for 50% business property relief. So if we can try and make the most of this relief, if we can try and make the most of our different nil rate bands and residence nil rate bands, then we can try and get as much of our estate as possible free of inheritance tax. And one way we can achieve this is by gifts during a lifetime. Now, if you gift any assets other than to a trust, that gift will be a potentially exempt transfer. So it's commonly referred to as a pet. And it's potentially exempt because provided you survive for 7 years, then that asset is outside of your estate for inheritance tax purposes. There are some taper rules. So if you don't survive for the full 7 years, there may be a reduction in tax, but they're quite complex. So we're not going to cover those today. If the transfer is to a trust or the gift is to a trust, then the position is different. that transfer is a chargeable lifetime transfer. And that's very much what it says on the tin. There's a charge during lifetime on that gift, but only to the extent that it exceeds the nil rate band, that 325,000. And when we're making lifetime gifts, we can't use the residence nil rate band, we can't use the spouse nil rate bands, we've only got that nil rate band available. So for a chargeable lifetime transfer, any excess over that nil rate band is taxable at 20% during lifetime. And if you should die within 7 years of the gift, then there's also potentially a further charge on death. So these are all things to bear in mind when you're considering, do you want to use a trust structure? Do you want to use a corporate structure? So that you know the tax consequences of each from an inheritance tax perspective. So the final tax I wanted to talk about today is capital gains tax. Now, this is not generally the driving force behind wealth planning. This is generally the sting in the tail, if you like. People will do planning which is inheritance tax efficient or income tax efficient, and then all of a sudden find they have a big capital gains tax bill. And this is largely because people assume that when they make a gift, because they've received no proceeds, then that gift is tax-free. This is essentially the case if you make a gift to a spouse, because there is a spouse exemption in place. But if you make a gift to, for example, your children, then actually the connected party rules means that gift is treated as a disposal at market value. And that means you could have a capital gains tax bill to pay to the extent any gains on that disposal exceed your annual exemption. Now, the annual exemption for 2021 is £12,300. This has historically just gone up a little bit year on year, but any gains that you make that fall within that exemption are capital gains tax free. Any gains in excess of that annual exemption will be subject to capital gains tax, and the rate of capital gains tax will depend on a lot of different factors. So start with, does your disposal qualify for business asset disposal relief, which is the renamed effectively entrepreneurs relief? If it does, then the gain above the annual exemption will be at 10%. Or if you qualify for investors relief, the gain above the annual exemption will be at 10%. If you're not within either of these reliefs, then you have to consider what your other income is in that tax year, and also what the asset is you're disposing of. So we have gains within the basic rate band are taxed at 10%, unless they are residential property gains, like a couple of other assets that fall within that, but broadly speaking, the main one is residential property. If your gains fall into the band above the basic rate band, then they will be taxed at 20% or 28% if they're residential property. So your other income will have a really significant impact on the capital gains tax rate you pay. And again, we want to try and be within these reliefs or be conscious of these different rates of tax, if possible, when we're planning, and make sure that we don't have an inadvertent sting in the tail. But one relief we can use when we are considering wealth planning is business asset gift relief. Now, obviously that means a trading asset, but it allows you to effectively move the gain to the person that you are gifting the asset to. So there's no capital gains tax for the person making the gift, but the person who receives the gift will have a capital gains tax charge in the future when they sell that asset. So that might be something you want to consider if making gifts is something you're keen on doing. So the final thing we want to consider in addition to the different taxes is the anti-avoidance legislation. So HMRC, as I'm sure you all appreciate, would prefer to have more tax rather than less tax. So where historically people have made quite basic gifts, they brought in different measures to try and prevent the income tax, inheritance tax or capital gains tax advantage of those gifts through these anti-avoidance measures. So the easiest way to explain these is really mentioning the gift that people made and that the legislation is designed to defeat effectively. So the first provision is the settlements legislation. And this was brought in where parents were gifting assets to their children, and the income was then taxed on the children using their personal allowance, using their basic rate band, which is really good tax planning. HMRC didn't like this, as I'm sure you'll appreciate. So they brought in the settlements legislation, which means that any income, if income arises on those assets over £100 in the year, then the full income will be taxed on the parent while the child is under 18. So that stopped that. The next anti-avoidance measure I wanted to talk through is the provisions around settler interested trusts. So HMRC have attacked trusts in a number of ways over a few years now, and they used to be really tax efficient vehicles. Now, if you give an asset away, you give it into trust and you continue to receive a benefit from the trust. Sometimes that benefit is received by your spouse or perhaps your children. Then the legislation can make the income of the trust taxable on you for income tax purposes, the gains of the trust subject to capital gains tax on you as though you made the disposals, not the trust. And in some instances, the assets are also within your estate for inheritance tax purposes. So what you're left with, if you fall really foul of these rules, is the cost of running a trust, but without any of the tax benefits. So that's something you really want to be cautious of if you're using trusts in your planning. The final anti-avoidance measure I wanted to talk through was the gift with reservation of benefit rules. Now, commonly people would give away the house that they live in to, say, their children, for instance, but they would continue to live in that house. And in this instance, HMRC have said, okay, well, that house will stay in your estate for inheritance tax purposes, as though you never made the gift, effectively. And that's the gift reservation rules. People manage to avoid these by selling their house and using the proceeds of sale to gift to their children. Their children then purchased a house for the parents to live in. That got round the gift reservation rules, so they didn't apply. So HMRC brought in some new rules. They brought in the pre-owned assets rules, and these effectively catch anyone that gets round the reservation of benefit rules. But they have an interesting tax consequence in that they actually generate an income tax charge for the person receiving the benefit. So that would be the person who originally gave the property away or gave the proceeds away. They would have an income tax charge based on the annual value of that asset. So if they've given away proceeds, it's been used to buy a house which they live in, that would be the rental cost of that property that they live in, which they would be subject to income tax on. Now, the anti-avoidance measures make it more difficult for some of the planning, but there are ways which we can work within these rules to still achieve some of our desired outcomes. So, for example, under the settlements legislation, whilst you can't give assets that receive income to your children who are at primary school age to pay primary school fees, you could give those assets to children that are over 18 to perhaps help with their university fees. And at that stage, once they're over 18, the income will be taxed on them, which would achieve the planning that you intended. So whilst they make things, the anti-avoidance measures make things a bit more difficult for us, they don't completely block the planning that we are able to do. We just need to make sure we work with the rules to achieve the best outcome. But it's important to flag these, and it's important that you're aware of these whenever you do any planning. So the easiest way to show you how the different options work, whether a trust is a good option for you, whether a company is a good option for you, is to use examples. And what we will go through today, Chris and I, is two different examples, one with a trading business, one with an investment business. And we use the two because the tax reliefs are different for trading assets and for investment assets. So it's important that we consider both and which options are better in terms of the different types of business and in terms of the different relationship of the family members. So the first example we'll run through is a trading business. It was established by the grandparents, and they brought the parents into the business, so they're all now shareholders. Grandparents have retired. They have pension income, they have investment income. They don't need the income from their shares. The parents, however, really do need the income from the shares. They've got children that are in private school. They need to pay the school fees and they need to run their family. So they draw substantial dividends from the company currently. They want substantial income currently, so they are higher rate taxpayers. And we can look at how we deal with this situation from a trust position and from a company position. We'll then both move on to the example 2, the investment business. And this is where the parents have built up a trading company, a successful trading company, which they've now sold. They're left with a pot of cash, and they want to use that cash to fund their retirement and also to help their family. And we can look at ways that we can deal with this from a trust perspective and from a corporate perspective as well, to make sure we achieve the intended outcomes and everyone is happy. So I will pass back over to Chris.
Now that Gemma's had a look at the two scenarios for us, I'll briefly go through the main differences between trusts and companies. The objectives in using a trust and a company have some similarity. We can use either of these options to separate out ownership and control. In terms of setting up a trust or a company, the terminology is different, but there can be similar functions and similar roles. When a trust is created, the person that sets it up is known as the settlor, and there can be one or more settlors. So a couple could create a trust each, or potentially could create a trust together. Similarly, the company is created by its initial shareholders, and again, there can be more than one, so a couple could be the original subscribing shareholders. Whoever creates the trust or the company is in control of its original terms and how it's set up. And depending on the options that are used and the flexibility built into the documents, those structures, whether it's a trust or a company, might be able to evolve over time. One of the main purposes of a trust or company is to separate out the management of assets from the ownership of the assets. Under a trust, the assets are owned by the trustees who manage them for the benefit of the beneficiaries. The beneficiaries do not own the trust, although they might be entitled to benefit from its income or its capital value. The company does give a greater level of ownership. The assets of the company are owned by the company itself and managed by the directors, but the company is owned by the shareholders. So although the shareholders do not directly own the company's assets itself, they have a defined interest in the income or capital depending on the rights attached to their shares. On a day-to-day level, the management of the trust or the company is with the trustees or with the directors, and their freedoms to make decisions will depend on the powers that are given either under the trust deed or the company's documents and the governing law or for trusts and for companies. The ability for trustees or directors to make certain decisions or act in a certain way can be limited if they need consent either from beneficiaries under the terms of the trust or from shareholders, depending on the way the Articles of Association have been prepared. Generally, beneficiaries under a trust are in quite a weak position, particularly under a discretionary trust, because they have very limited ability to dictate how the trustees can act or to demand that the fund is distributed in a certain way. Shareholders might be in a stronger position, but again, this will depend on the company's rules and the rights that are attached to those shares, and whether they have voting powers at company meetings or whether they would be able to dictate terms or have influence over significant decisions that the directors would want to make. If a trust receives income or dividends, then the trustees' options on how to deal with that money will depend on the type of trust that's been created. Under an interest in possession trust, one or more of the beneficiaries would have an automatic right to receive income. The trustees would be under a duty to pay it to them. Under a discretionary trust, the beneficiaries don't have automatic rights, and the trustees will have discretion to either accumulate the income within the trust or to distribute some or all of it as they see fit. So a discretionary trust provides the trustees with a lot more flexibility. Trustees don't necessarily have to treat beneficiaries equally, so they can distribute to different people at different times on a discretionary basis. If the directors of the company issue a dividend, the amount received by the shareholders depends on the number of shares they own and any rights to dividends that are attached to those shares. If all of the shareholders have the same types of shares, they'll receive a corresponding slice of the dividend equivalent to the proportion of shares in the company that they hold. Different categories and classes of shares can be used to restrict or provide flexibility for the payment of dividends, and that's something that we'll look at in more detail later on. Families are always concerned to know who will ultimately receive the capital that's held by the trust or the company, because it's going to be sitting on a significant proportion of the family's value, and they want to know how it will ultimately come out or whether it has to stay in forever. Trusts have to have a maximum trust period, and the default set by law is 125 years, although it's very common that trusts would be wound up well within that period. The settlor is the person who has the initial decision to make about the length of time that the trust will run. So, for example, they could limit it to a certain number of years, or leave it at the statutory maximum of 125, or limit it to a person's lifetime, or a beneficiary reaching a specific age. There's a wide variety of triggers that can be used to bring the trust to an end. The trust document will say who the capital passes to when the trust does come to an end, or whether the trustees have discretion to distribute it at that point. Commonly, trustees would also have the ability to appoint capital to beneficiaries during the trust period, so basically take it out of the trust and give it to beneficiaries as their own asset, freed from the terms of the trust. Companies don't have the same limitations on the duration, and they could run for, well, indefinitely really. Capital can be released from a company by the directors to shareholders, but this needs to be carefully considered in each case, and the corporate options for dealing with that are really outside of the scope of what we're looking at today. But briefly, if the company is no longer required, it could be wound up and the assets distributed to the shareholders. Again, this will depend on the rights attached to the shares as to sharing in capital on a winding up. Having looked at the comparison of the legal structures, I'll now go back to the two case studies and we'll see whether trusts can be used to provide suitable solutions for the families. Before looking at the case studies in detail, I just wanted to take a couple of minutes to think about the advantages of trusts generally. A significant factor is the level of control that the trust gives to the trustees. Trustees are generally in a strong position because they're given the ability to manage the trust's assets in a flexible way. Trusts should give them wide-ranging powers to invest the trust's assets. Now, if you're dealing with a family company, the trustee's decision might be restricted because their whole purpose is to maintain ownership of the shares within that company. But if they receive other cash or dividends, or they have the ability to accumulate funds, they would also need powers to be able to invest that externally or to maintain bank accounts and other types of investments. The trustees do need to act responsibly, and the exact terms of the trust will set out any limitations on what they can do. If a beneficiary is entitled to income, for example, then the trustees have to pay that income to the person until or unless the right to income is changed at a later date. Trusts provide protection to preserve the assets, as the beneficiaries can't use them unwisely and can't pass them on to anyone else. If a beneficiary has financial difficulties, such as a divorce or personal financial issues, the trust can provide protection because the beneficiary doesn't directly own the assets that are held in trust. Families might be in a position where the older relatives have significant assets and want to pass them on to the younger generations. If, for example, grandparents have significant capital, but passing that wealth on to their own children would cause tax issues, they might want to look at passing money on to the grandchildren or using it for their education or setting them up in life. However, grandparents are often wary of putting too much money in the hands of younger people. And if the grandchildren are very young, as Gemma's just mentioned, their tax allowances are available for families, but a structure needs to be in place to make sure that the money can be suitably used for them, because young children wouldn't be able to deal with the payments and investments themselves or to give legal receipts to their grandparents for the money that's been handed over. From a school fees planning perspective, the use of trusts can be a very flexible option for families. The capital can be preserved and even grow within the trust, being used to build up a fund to meet the school fees and university tuition, but without it being taxed at the parents' rates. Parents might actually be the ones controlling the spending as the trustees, but if they haven't created the trust, then they're not going to be caught by the settlements, legislation and restrictions. Beneficiaries may be vulnerable for a variety of reasons, which could be their age, whether they're young or old, or due to physical or mental health issues. If there are concerns that a beneficiary might be susceptible to financial abuse or influenced into making poor decisions, or if they don't have capacity to make their own financial decisions, then a trust can help to protect their position. The beneficiaries are still able to benefit from the trust or to have the funds used for their advantage, but they don't have direct ownership, so they can't spend the money unwisely. In some circumstances, beneficiaries might be eligible for means-tested benefits or support, and the inheritance or receipt of assets could affect those entitlements, and the trust could be used to allow the family to still support the person without adversely affecting their entitlements to state benefits or means-tested funding. So looking at example one, just very briefly recap the first set of facts before we look at how a trust could be used by this family. The key elements from the trust perspective are that the grandparents are in a position to be able to part with the assets and they want to support the grandchildren. The middle generation, the parents, are paying high rates of tax, so passing money from the grandparents to them won't be the most tax efficient arrangement. And as the grandchildren are in school, let's assume for the moment that they're under 18 and not able to manage the money or the assets themselves. The company's status as a trading business is going to be important from the tax perspective, both on creation of the trust and in the future during its potentially very lengthy lifetime. So A solution for this example is for the grandparents to create a trust. They do this by signing a trust deed, which sets out the details of who manages the trust, appoints the trustees, and who can benefit from it, defining the beneficiaries. It'll also set out any special rules for management of the fund. The grandparents could be the trustees themselves, or they might appoint other members of the family, or independent trustees, whether these are other relatives, friends, or professional advisors. Generally, you'd need more than one trustee, normally up to a maximum of 4. In this case, the trustees will become the shareholders in the family company and would have the right to vote at company meetings or exercise shareholder rights given to them under the company documents. If the trust owns any other assets, such as bank accounts or investment portfolios, those would again be owned in the name of the trustees. The trust deed will set out the details of the people who can benefit, and sometimes it's appropriate to name individuals, but it's also possible to include broader categories of people. So we might refer to grandchildren or the descendants and future generations of the family. For flexibility, it's also possible to say that other people could be added to the list of potential beneficiaries in the future. And often we'd put in some sort of restrictions, such as there needing to be consent from at least 2 of the existing beneficiaries before anyone else could be added into that list. The people named as the potential beneficiaries don't have any automatic right to income or capital, and the trust will set out what happens to both of these scenarios. Whether or not there's an automatic right for a beneficiary to receive income is very significant when we look at the way the trust is taxed. So an income right is often referred to as an interest in possession, although this could also refer to using the trust's assets, such as living in a property owned by the trust. If a beneficiary is given an interest in possession, the trustees would have to pay the income, or any dividends in this case, to that person. And this can sometimes simplify the administration of the trust, because the trustees can arrange for the payment to be made direct to the beneficiary. It's possible for more than one beneficiary to have an interest in possession under the trust, and the deed would need to set out what proportion of income is going to be paid to each of those income beneficiaries. If no one has an interest in possession, then the trustees have discretion over the use of the income. They'd be able to decide whether to accumulate it or whether to pay some or all of it out to the beneficiaries. And just because payments made to one person from the potential beneficiaries list, it doesn't mean that anyone else has to receive an income payment, even if they're within the same category. So for example, the trustees could pay the school fees for the grandchildren from one branch of the family, but not from the other branch, depending on the circumstances. Trusts are often very flexibly structured so that they can be changed in the future if needed. So if a trust starts off with an interest in possession, it's quite common for the trustees to have the ability to terminate that life interest or the interest in possession and run the trust either on a discretionary basis or pass the interest in possession to someone else. So if the income beneficiary's needs change and they no longer require income from the trust, the family would be able to look at who else could benefit from that income. Similarly, if the starting point was that we set up a discretionary trust, the trustees would be able to grant someone an interest in possession under that fund and convert it essentially to an interest in possession trust. This flexibility means that it can be adapted to suit the needs of the family and the changing tax rules from time to time. The trustees might want to release some of the capital assets from the trust and give it to the beneficiaries, but not necessarily wind the trust up. So if there's an interest in possession and the trustees were to take capital out and give it to someone else or to that beneficiary, it would affect the amount of income that's generated for the income beneficiary. And the trustees need to weigh up the needs of the various people involved. There might be alternatives available to the trustees, such as lending some of the capital to the beneficiary or appointing it on a revocable basis so that they could, in the future, revoke their decision and bring that capital or those assets back into the trust fund and use them for someone else's benefit. In this example, the trust would allow the potential beneficiaries from the family to share in the dividends and the growth of the company, but without becoming direct shareholders. And issues can sometimes arise within family companies when shares are inherited and the overall size of the shareholding becomes diluted. The shares originally held by the grandparents in this case could end up being spread between a larger number of children, grandchildren, great-grandchildren over the years and in various fractions. And this can make decision-making trickier for the company directors if they need shareholder approval and have to go to a multitude of family members for approval. The trusts could be used in a way to simplify this structure for the family. So if each branch of the family has a trust containing their shares, the actual number of shareholders the director has to deal with is more limited because you just have one trust per branch of the family. But within each trust, the wider group of family members can benefit from their share in the company, and it can be used more flexibly for that particular branch of the family's own needs. From the point of view of protecting assets, the ownership of shares through the trust means there won't be issues around whether a family member can pass their own shares onto their spouse or to children in the event of an inheritance. And it also means that the beneficiary doesn't own the shares themselves in the event of divorce or financial problems, so it can give some more protection on that basis. In terms of tax issues, inheritance tax becomes relevant at various times for a trust. The starting point will be when it's created. So if the value going into the trust is more than the settlor's nil rate band, taking into account any other trusts that they've created in the past 7 years, then an entry charge will be payable, and that's 20% of the value over the nil rate band. It might be possible to claim business property relief if the assets meet the right qualifying conditions. And in the example we're looking at, if it's a trading business which has been held for more than 2 years, then it's likely that the 100% business property relief would apply. As Gemma mentioned, there can be reliefs at different rates depending on the assets that are going in. In the case of this family, it looks like we'd be able to use business property relief to minimise some of the tax. But again, the warning that they need to also consider capital gains tax, because this would be a disposal for the grandparents when they're putting the shares into the trust. Inheritance tax becomes relevant again if capital is either taken out of the trust and on each 10-year anniversary. The 10-year periodic charge reassesses the capital value of the trust's assets, and a tax charge can then be applied. Now, it's at a reduced rate and generally works out at about 6% as a maximum, depending on the reliefs that are available and the value of the trust. The trust will have its own nil rate band, and if the qualifying conditions for business property relief are still met at the 10-year charge, then it can be applied at that stage. Situations can arise, however, where the trust was tax-free when it went in because it qualified for business property relief, but if the business is sold during that 10-year period and the trust is then sitting on cash or investments which don't qualify, then it won't be able to claim business property relief anymore. So you could have an exempt trust when it's created, but a taxable trust at its first 10-year anniversary. And inheritance tax is an issue when assets leave the trust because an exit charge can be calculated then. The exit charge relates back to either the charge on creation or the last 10-year charge that was conducted. And the calculation of the exit charge is quite complex because it refers to the number of completed quarter years that have elapsed between creation of the trust or the previous 10-year anniversary charge. Trustees also have to be careful to bear in mind the interaction between the trust's tax position and those of the beneficiaries. So assuming that the trust isn't taxed as belonging to the settlor or the income isn't taxed at their personal rates, if a beneficiary has an interest in possession, the income received is generally taxed on the basis that it belongs to that income beneficiary because they've got the right to receive it. The trustees would pay basic rate tax and the beneficiary declares how much they've received within their own tax return. And the tax that's been paid by trustees would be taken into account when the beneficiary's own tax position is then calculated. Depending on the beneficiary's own tax rate and available allowances, they might either receive a refund if tax has been overpaid or potentially have to pay more tax if their personal income exceeds the rates that's already been paid by the trust. In some cases, we can simplify the administration of income by having it paid direct to the beneficiary. If it's a discretionary trust, the same rules don't apply, and the trusts would be taxed at the highest rates, which is 38.1% for dividend income and 45% for all other income. And although there's a lower rate for the first £1,000 of income, trusts don't benefit from the same savings allowances and dividend allowances that individuals would get. And if the trustees then exercise their discretion to distribute some of the income to the beneficiaries, the beneficiary can claim back some tax so that they don't lose out, but the trust has to have paid enough tax to meet the full payment to HMRC Otherwise, an additional tax payment may become due from the trust. So in summary on this example one, the example is that the grandparents can retain control of the assets by becoming trustees, and the trust structure allows them to keep a close eye on what happens with the wealth that they're setting aside for the family. They'll be able to flexibly use the company's shares to provide income or capital for the grandchildren and the wider family, and they can adapt the trust over time to meet the family's continuing needs. If we move to the second example, to briefly recap on the facts for this one, in this case, the parents have sold the trading business and want to provide for the family, but to ensure the parents can continue to benefit. And it's that final aspect which is going to cause problems for them in looking at what trusts to use, because if they want to continue to benefit, then their tax consequences are not going to be favourable for them. To prevent the trust being caught by the reservation of benefit rules or the settlements legislation, they need to be excluded. And this is going to restrict their ability to use the fund in the future for their retirement if they've wrapped it up in a trust, because they would have to lose control or not be beneficiaries of it in order to have the more favourable tax treatment. Also, because this is an investment business, or they've sold their business and they're going to be using investments, it's not going to qualify for business property relief. So we'd be looking at an entry charge for inheritance tax applying to any assets over the available nil rate band when they create the trust. So they might decide to limit the value that they put into this trust, which again is going to limit the protection that it provides for the family, but on the other hand would keep more in their personal ownership, which they could then consider using different options for planning for their retirement or longer term use. If they did decide to go ahead with the trust, they'd have the same issues to look at that were mentioned before for the settlor in terms of deciding who the trustees are going to be and whether anyone would have an interest in possession or whether it's going to be a discretionary trust. There could be other alternative approaches that the family could look at using, and the main issue being their concern to make sure they have enough for their retirement. Obviously, the best way to make sure they have enough is that they could retain the assets, and they could keep an eye on pension planning or post-death planning, and also look at gifts as the children become older, or if the tax rules changed and it became more favourable to use trusts. They should also consider the terms of their wills and how assets would be protected in the event of the first spouse's death. So on the first person's death, the assets could be at risk if they're inherited from the survivor, and the survivor then goes on to form a new relationship or have children or stepchildren from a subsequent relationship. And the inherited assets could end up passing to people outside of the family of the first spouse who died. A will trust could be used to create an interest in possession for the survivor, which gives protection over the capital, but still allows the survivor the use or benefit from the assets. And careful will planning would allow for the use of inheritance tax exemptions and reliefs as well. So if we had any business property relief or the use of spouse exemption, we can use that to flexibly minimise the inheritance tax payable on the first person's death. Alternatively, the families in both examples could use companies, which Gemma will be looking at in a moment. Before handing over though, as a final point, I'd just say that it's worth bearing in mind that because a trust can be a shareholder in a company, we can combine both of these structures together to give an even greater level of control for families. So I'll hand over to Gemma now to look at the corporate route of addressing these two scenarios.
Thank you, Chris. So, as Chris made reference to, there are a number of reasons why you would want to use trust. There are similarly a number of reasons why a company would be the preferable route for you and your family. Now, as Chris said, if you've got an investment business, that tends to lend itself more tax efficiently to a corporate structure than to a trust structure, particularly if the donor of the gift wants to continue to receive a benefit. But again, as Chris said, there's no reason why you can't use the two together, why you can't have a company holding the investment business, but some of the shareholders of the company are trusts. And that's particularly helpful if you've got shareholders who might be a little too young or not quite responsible enough to deal with the wealth that the company could generate. So there are ways in which you would use both the corporate structure and the trust structure combined, and you shouldn't necessarily consider excluding one or the other. What I tend to see more with my clients is that where they've always had a company, The reason they like the company structure is because they're familiar with it, and there's some comfort in familiarity. They know how a company works, they know how to extract funds from a company, and therefore, whether or not that's more tax efficient, the company just works better for them and their understanding of legislation and rules. Another reason people would tend to favour companies, particularly when I first speak to them, is the really negative press that trusts have received recently, and this misconception that trusts are tax avoidance vehicles. Now, trusts previously were really tax efficient, and a lot of changes that HMRC have made them less tax efficient in recent years. But they still have a really important role to play in terms of protection of the family assets, and particularly so if you've got vulnerable beneficiaries that have dependencies on different types of substances. They're a really important aspect in family planning. So they should never really be just cast aside for any reason. And HMRC are not against them, despite the press that might say otherwise. So that's really where I get to when people come to see me and say, is a trust the best route? Is a company the best route? So I'm going to run through the same examples as Chris did, with exactly the same facts, but I'm looking at this from a company situation rather than a trust situation, and how we can solve the problem using companies. So if we go to the first example, the trading business, again, a quick run through of the facts. This is a family business established by the grandparents. The parents are also shareholders in the company. Parents need the income because they've got some high school fees to pay for their children. Grandparents don't need the income at all. So what can we do in this scenario? Well, the grandparents can gift the shares down to the grandchildren. They can claim business asset gift relief on that gift so that they don't have a capital gains tax bill, but the grandchildren would have that capital gains tax bill in the future when they sold their shares. Because the gift is grandparent to child rather than parent to child, the settlements legislation doesn't catch here. So the dividend income on those shares are taxable on the grandchildren, using their personal allowances, using their dividend allowances, and their basic rate bands. Now, from an inheritance tax perspective, this gift is a pet. So provided the grandparents survive 7 years, the gift is outside of their estate for inheritance tax purposes. But because these are trading assets, there is almost like a fallback plan, if you like, so that if the grandparents die within the 7 years, provided the grandchildren still hold those shares and the company is still trading and still meets the other requirements, then the value of the shares that comes back into the grandparents' estate could still qualify for business property relief and therefore be exempt from inheritance tax anyway. So we've got a bit of a fallback plan when we look at trading businesses. Of course, the grandparents don't have to give away all the shares. They can retain some shares in the company. So they've still got a potential future right to income, potential future right to capital, if that's a concern. And they may be able to keep control by retaining shares as well. And that may be what's more important to them than the tax implications. So being more accountancy background than legal background, I like some numbers. So I've run this into a quick example, just so you can see the actual income tax savings we could generate by planning in this way. So if we assume that the business had 4 shareholders, the grandparents each held a quarter and the parents each held a quarter. If the grandparents gave all of their shares to the grandchildren, we've now got the parents owning half the company and the grandchildren owning half the company. Now, the parents previously needed 130,000 each to support their day-to-day living and to be able to pay those school fees. If we spread this across the children as well, then actually they need 65,000 each rather than 130. And by moving the income down to that level, what we're doing is allowing the parents to regain their personal allowance. So you may remember from the income tax slide, if you go over 125,000, you've lost your personal allowance, that 12,500 tax-free. So if we regain that, that's the tax saving of £4,062.50, just by bringing our income a little bit lower. We're also able to use the grandchildren's personal allowance and their dividend allowance. So that's 14,500 in total tax-free. And then we've got dividends now taxed in the basic rate band on those grandchildren, rather than in the higher rate band on the parents. So all in all, if we run through the numbers quickly and get to the end result, we've got a saving, and this is 18,150 per parent. So overall, that's a big sum of money per parent per year. And combined for the family, a nice additional amount of income, despite the company only paying the same amount now out in terms of dividend income. We're just spreading the income across the family members rather than taxing it solely on two of them. So if we now look at the corporate route for investment businesses, so reiterating the facts, the parents have sold their trading business, they've got that big pot of cash. They want to use it to benefit the family, but they also want to make sure there's some money there for them in their retirement. Now, the investment business is more difficult than the trading business because there are a few different catches that we need to be aware of. So when we give a gift of an investment business or cash, this is a pet, but there is no fallback, no business property relief fallback. So if the parents don't survive for 7 years from the date of the gift, then that whole amount is back in their estate for inheritance tax purposes. So we need to be cautious of that when we're dealing with investment businesses or investment assets or gifts of cash. You also need to obviously bear in mind that once you've given away the funds, you can't receive them back. So let's see if we can look at a structure where there's potential to still recover something in the future, even though it's not the actual gift that you've made. We also, of course, have to bear in mind the settlements legislation, which prevents gifts from parents to children that give rise to income in excess of £100 per annum, because that income would then be taxed back on the parents while the child is under 18. That's going to take away any benefits that we might have otherwise. And then, of course, you've got the concerns, as you would always have, on the responsibility of your children and the risk of losing family wealth in the event of divorce. And I think at this point, it's probably worth just mentioning that companies can balance that in many respects. They can offer some form of protection, but they can rarely offer the same form of protection as a trust. So if protection is your key driver with your wealth planning, trust really should be something that you consider in that respect, because the company can't offer quite the same level of protection as a trust can. So if we go to our solution on the investment business, if the proceeds of sale are loaned to a company, rather than the cash being gifted to the family members, then we can set up this company with the two parents and the two children as shareholders. But at the time of establishment of the company is not worth anything. It's received a loan, yes, but that loan is repayable to the parents. So the standing value of the company at that point is nothing. So the gift for inheritance tax or for capital gains tax purposes is really marginal, or maybe £1 shares, which the children can invest in themselves. So that's good. So we've made no potentially exempt transfer. We've made no transfer of value for capital gains tax purposes. But as the parents draw down on the loan to fund their retirement, then the value of the company grows. And that growth in value has effectively been passed to the children by the parents, but without triggering capital gains tax or inheritance tax charges. Of course, the company will use the cash to invest in assets. Perhaps they invest in property and the property increases in value. Again, all of that growth is spread between the shareholders. So again, we're moving funds to the next generation, but without having made a gift for capital gains tax or inheritance tax purposes. Income can be paid out to the shareholders in the form of dividends, but it's worth bearing in mind that if you have one class of shares, the same dividend will need to be paid to all of the shareholders in proportion to the number of shares that they hold. And parents may not want to pay large dividend amounts to children, but they may still want to have quite a lot of income themselves. They would then use the loan drawdown to try and fund any deficit. The parents can also charge interest on that loan, and that's one way of getting out income or extracting profits from the company without paying dividends to all of the shareholders. The interest they receive can use their savings allowance, so that could be tax-free. It's also corporation tax deductible for the company. And of course, by having this company structure, the parents can retain control, or they can have some element of influence over what the investments are and how the company works, and when the dividends are voted, how much is paid out. So that can be a really helpful thing. In addition to the tax efficiencies, is trying to make sure you retain that control, you retain that protection. So again, I like numbers. So I've done a quick calculation of what this means in number form. So if the parents needed 50,000 per year, and that's their income needs, then they can draw a salary, 12,500 within their personal allowance. There are various reasons why you might want to do this. One of them is if you are not of pensionable age. By taking a salary, you could qualify for the national insurance contributions that help towards state benefits. Or you might want to top up your pension pot, and you would need income that's not passive income, so earned income like salary, to give you the pension reliefs available. And that salary would be corporation tax deductible for the company. You could also take interest. And as we said, if you're in the basic rate band, then you would have no income tax on the £1,000 due to the savings allowance. Again, interest is tax deductible for the company. You could also take a dividend. This would need to be paid to all the shareholders, but you could take £2,000 dividend allowance, and that goes to all of the shareholders tax-free, subject to the settlements legislation, because the children may be under 18. And you could draw down on your loan to get you to the balance that you need from the company. So in that way, you're extracting £50,000 worth of value from the company, paying no tax on that extraction at all. And the benefit of this is that some of those extractions are corporation tax deductible, so you get a further 19% tax saving on those elements. But just bearing in mind that any dividends do have to be paid to all the shareholders. So even if you've got an investment business rather than a trading business, there are still ways which we can use a company tax efficiently and to achieve what you need to from it. So the main issues that are often flagged with a company are the loss of control. People don't like to give away assets and then lose control. And the best way that we can deal with this is to reclassify shares with different rights. So rather than giving one class of ordinary shares to all of the shareholders, we could give the grandparents A shares and they could have the voting rights. Then the parents and the children might have more shares, but they might be B shares. So they would have rights to income, but they wouldn't have that casting vote. So the grandparent, even with just one share, could retain that voting control. And that sometimes is enough to keep grandparents happy and comfortable in the gift that they're making. There's also the different income requirements which need to be considered. Now, this is much more easily achieved with a trust structure than with a company structure. If you have all of the same shareholders and they're all ordinary shareholders, you have to pay the same rate of dividend across all of the shares based on the proportion of shares that you hold in that company. And this might not be beneficial. So if you have grandchildren in primary school, some in secondary school and some at university, they will have different income needs to support those school fees. So perhaps you might want to consider different classes of shares for different grandchildren. So you could have A shares for one, B shares for another, C shares for another, and each of them could have different rights depending on the age of that child or the amount of protection you want to secure. If you restrict the ability to sell the shares, for example, then you are devaluing those shares and making them less of an asset if that particular shareholder should get divorced in the future. You can't protect the shares in the same way that you can with a trust. So discretionary trusts can prevent there being any asset on divorce in some instances. You can't do that with a company, but you can offer some form of protection by using different share classes and different rights on the different shares. You should bear in mind, though, that the more restrictions you place on those shares, the more you devalue them. And that's relevant when you're looking at inheritance tax, because if you're trying to move funds out of your estate and assets out of your estate, the less value those shares have for inheritance tax that you've given away, the more value you're retaining on the shares that you own. So there's a balance to be had there. So I had some final thoughts just before I finish wrapping up this case study, is that most of the time that people come to see me is driven by tax and they want to have tax savings, and they're sure that giving gifts away during lifetime is the way to secure these tax savings. And actually, that's not always the case. In some instances, actually doing nothing creates a better tax outcome than doing something. So I can explain this best with an example, really. So in this case of Beryl, her estate is worth £1 million. Of that 1 million, there are 775,000 shares in a trading company, and these qualify for 100% business property relief. So if you're savvy with numbers, you'll know that leaves her with a nice 325,000 nil rate band of taxable income, which of course isn't taxable because of the nil rate band. Those shares, the trading company shares, are standing at a gain of 100,000. So if she sold them now, that would be the gain that she's subject to capital gains tax on. Beryl has been single all her life, so there's no spouse exemption. She's also got no children, so there's no residence nil rate bands that we can take into account. So we've really just got that 325,000 tax-free for inheritance tax purposes. Beryl doesn't need the income from those shares. So she's thinking, let's give these shares away to my nephew during my lifetime, and that will save tax. So if she does that, her nephew receives those shares and sells them straight away. He has that 100,000 gain, assuming she's claimed business asset gift relief. 100,000 at 20%, because assuming that's going to be mostly in his higher rate band, will be £20,000 of capital gains tax. If Beryl dies within 7 years, and the nephew's already sold the shares, that business property relief fallback that we had is gone, because we don't have shares in a trading company anymore. So we now have a gift, a pet, back in the estate and back subject to inheritance tax. And the inheritance tax on a 775,000 gift is 310,000. So by making that gift during her lifetime, the actual tax cost is 330,000 when you consider inheritance tax and capital gains tax, which is a huge sum of money to pay. If, however, Beryl hadn't done any planning, she'd just done nothing, kept the shares and died still holding the shares, with them still being business property relief qualifying. So on Beryl's death, the 775,000 will be covered by business property relief, so inheritance tax free. That would leave 325,000, which is covered by the nil rate band, so no inheritance tax to pay on Beryl's death. The shares then transfer to her nephew at probate value, because you have a capital gains tax free uplift on death. So they pass at 775,000 value. He sells them quite quickly afterwards. There's no capital gains tax for him to pay because his cost and his proceeds are very similar. So if she hadn't made the gift, there would actually be no inheritance tax and no capital gains tax. She would have been much better off. And it's worth just considering that actually everyone's position is different. It all depends on the inherent gains in the asset. It all depends on the rest of your estate. So you can't automatically conclude that a gift during lifetime is definitely the most tax efficient approach. It's something you would always need to discuss with an advisor to check your position from a variety of different tax aspects. So that moves me on to my conclusion. And there's very much it depends. And I appreciate that a lot of people say that's always an accountant's answer to every question, but it does depend on your situation. It depends on your relationship with the person you want to give the gift to, and whether you're caught by any of those anti-avoidance measures. It depends on what you're familiar with, whether you're more comfortable with a trust or a company. It depends whether you're dealing with trading assets or non-trading assets, and what you need for your income needs, as well as the income needs of the beneficiaries. And that will drive what type of gift you make. If it's a company gift, do you want different shareholdings? Do you want different classes? And how important is protection? How important is control? If protection is fundamental and outweighs all of the tax implications, then really your trust should be your main go-to in that respect. So you need to consider a lot of factors. There's not one size fits all. Unfortunately, if it was, it would be a much easier job for Chris and I to conclude on this advice. But it hopefully gives you something to think about and something that may be of interest to you if this is something that you're considering or something your family members are considering and you want a bit more information on it. We did have some questions. The main focus of the questions, to be honest, has been around the capital gains tax reform, which I'm sure you've all seen in the press. We did expect this, to be very honest. So in a typical, here's one we prepared earlier, we have got a quick slide on this, so I'll run through this very quickly. Apologies, I appreciate we're running over. The capital gains tax reform, which were published, the second part of it was published last week, included some recommendations. And one of those recommendations, which actually came from the inheritance tax review published last year, was the removal of this capital gains tax free uplift on death. And that will be relevant to the final thoughts slide that I discussed. So the removal of that 100,000 gain, that will no longer be the case. But that's only if the government decides to go with these recommendations. And obviously without a crystal ball, none of us will know whether that will definitely happen or not. But it has been an inheritance tax review. It has also been in the capital gains tax review. But since these reviews were commissioned by the same office, the Office of Tax Simplification, it's not really a surprise that they were in both. The main outcome of the capital gains tax review was really simplification. And I think you'll be able to see from the various slides on the overview of the different taxes. Capital gains tax is a complex tax. There are lots of different rates. It's very difficult to understand what your actual liability is until you've got to the end of the tax year and you know what your other income is. So when looking at things from a simplicity perspective, the recommendations have been that you make things easier. You align the income tax rates, you align the capital gains tax rates. Now, this has been done historically. The capital gains tax rate used to be 40% in line with the top rate of income tax. So the fear is, of course, that the capital gains tax rate will go up from a top rate of 28% to a top rate of 45% in line with the highest rate of income tax. It's not a definite. I would reiterate, I can't reiterate enough, this is not a definite, this is a recommendation. And the government will have to take a view on whether they want to support simplification, because in some instances, this will actually cost them money rather than save them money. And I'm quite sure they will want more tax rather than less. So some of the recommendations, for example, the annual exemption reduction, historically, this hasn't generated any difference in tax by moving this annual exemption around, because those with investment portfolios will just aim to make sure gains are within the annual exemption. So whether you move it up slightly or down slightly, the investment providers will still work within whatever parameters they're given. The one that has upset most people, I think, is the possibility of the removal of entrepreneurs relief. So that was renamed last year to business asset disposal relief. It didn't really have any other changes. It was just a rename. And there's always been the fear that that's going to be removed. The recommendations are not actually to remove this relief. They just want it more focused on retirement. So if you have a business and you're an owner-managed business, you shouldn't necessarily have any problems if they brought in these reforms, because it should still be catching you. It's really those cases where it's a relief not for people retiring, just in relation to shares they hold that might be in the right type of company. And that's what the review was quite heavily focused on. So I hope that just by running through those quickly, that may have helped with a few of the questions you may have had. Quite a few of the questions were focused around this, but if there are any follow-up questions, we have got my details and Chris's details, and if we can be of assistance after the webinar, please feel free to contact us on the email addresses or by giving us a call. Okay. And that brings us to a close on this. Thank you very much for listening today. I hope you've enjoyed it and it's been useful. And I look forward to doing another one, hopefully, with Chris shortly.